In late 2025, a warehouse manager in Ohio checks his phone during a lunch break. The headline isn't about politics or war, it's about silver. Again. He scrolls past it at first. Silver has always been there, quietly sitting in the background of the financial world. Nowhere near as dramatic as stocks or as emotional as housing. But this time, something feels different. Prices aren't just moving, they're accelerating. And what unsettles him isn't the number itself, but the pattern behind it. This is how most major financial shifts begin, not with panic, but with a faint sense that something ordinary is starting to behave in an unusual way. For decades, silver has been treated as a side character. Gold gets the headlines, stocks get the attention, real estate gets the dinner table debates. Silver is industrial, boring, practical. It's used in electronics, solar panels, medical devices, and quietly tucked away in vaults and inventories. But history shows that when silver starts speaking loudly, it's rarely about silver alone. To understand why people are whispering about a possible 2026 spike, you have to step away from charts and think about systems. The financial system most people live inside today was designed for a world that no longer exists. Stable jobs, predictable inflation, affordable housing, pensions that actually paid out. That world faded slowly, then all at once. A teacher in Manchester earns more on paper than she did 10 years ago, yet her rent has doubled. A family in Toronto owns a home worth more than they ever imagined, but they can't afford to move because replacing it would cost even more. An engineer in Sydney watches grocery bills rise faster than his salary reviews. A delivery driver in Texas juggles credit cards, not for luxury, but for groceries and fuel. This is the backdrop, and this is why silver matters. Most people misunderstand what silver price movements really signal. They assume it's about investors trying to make a quick profit or speculators chasing headlines. That misunderstanding is comforting because it suggests nothing fundamental is changing. But historically, silver spikes tend to appear when confidence in financial plumbing begins to weaken. Not collapse, but quietly erode. Inflation plays a role, but not in the way people expect. Official inflation numbers rarely match lived experience. When housing, insurance, healthcare, and education rise faster than wages, people feel squeezed even when reports say inflation is cooling. That disconnect creates behavioral shifts. People save differently, spend differently, borrow differently, and institutions adjust behind the scenes. Silver sits at an intersection most assets don't. It is both money adjacent and industrially critical. When manufacturing expands, silver demand rises. When trust in currencies softens, silver demand rises. When governments inject liquidity into economies to keep things running, silver doesn't argue. It reflects. What's different now is that multiple pressures are arriving at the same time. Governments across the US, UK, Canada, and Australia carry debt levels that would have been politically unthinkable 20 years ago. Servicing that debt becomes harder when interest rates stay elevated. Keeping rates high pressures housing and jobs. Cutting rates risks reigniting inflation. That balancing act leaves little room for error. At the same time, the global push toward electrification and renewable energy isn't slowing. Solar infrastructure alone consumes massive amounts of silver. Medical and defense applications add another layer of demand. This isn't speculative demand driven by fear. It's structural demand driven by policy and industry. Meanwhile, supply isn't responding the way textbooks predict. New mines take years to develop. Environmental regulations tighten. Ore grades decline. Recycling helps, but not enough to offset growth. Silver doesn't flood the market just because prices rise. It resists urgency. This is where the idea of a systemic reset begins to surface. Not a dramatic collapse, not an overnight failure, but a slow repricing of what things are actually worth when the old assumptions no longer hold. For decades, many Western economies operate on the assumption that growth could outpace debt, that productivity gains would smooth over imbalances, and that asset prices rising faster than wages was acceptable as long as credit remained cheap. That assumption is under strain. And when credit tightens, when housing affordability breaks down, when pensions rely more on market performance than guarantees, the system begins sending signals. Silver is one of those signals, not because it is magical or immune to volatility, but because it reacts to both physical and psychological pressures. When confidence is high, silver behaves like an industrial metal. When confidence wavers, remembers its monetary past. Most people don't watch these transitions because they're subtle. A few percentage points here, a supply report there, but institutions notice. Central banks may not hoard silver the way they do gold, but industrial stockpiles, long-term contracts, and strategic reserves tell a quieter story. The average person sees prices rising and assumes it's too late or too risky. That reaction is understandable. Financial history has trained people to fear being the last one in. But systemic shifts rarely announce their peak at the beginning. They unfold in stages. The first stage is disbelief. The second is rationalization. The third is normalization. By the time something feels obvious, the deeper consequences are already embedded. Right now, we are somewhere between disbelief and rationalization. People explain silver's movement as temporary, a supply issue, a geopolitical scare, a passing trend. Those explanations aren't wrong, but they're incomplete. They miss the broader context of a financial system adjusting to long-term constraints. Think about retirement. In the US, 401k balances rise and fall with markets. In the UK, pensions face funding pressures. In Australia, superannuation grows, but housing costs absorb more of retirement income. These systems depend on stable returns and controlled inflation over decades. When volatility increases, when purchasing power erodes faster than expected, even well-designed plans feel fragile. Silver doesn't fix these problems, it reflects them, and that reflection is becoming harder to ignore. If a significant repricing is coming in 2026, the question isn't whether silver hits a specific number. Numbers distract. The real question is what that movement tells us about currency trust, industrial strain, and the limits of policy tools. Because if silver is reacting to a deeper reset, then focusing only on silver misses the point entirely. If the signals continue and nothing meaningfully changes, the consequences won't arrive as a single shock. They will arrive quietly, through daily decisions that feel rational in isolation, but reshape the system over time. When currencies lose small amounts of trust, people don't rush to abandon them. They adjust behavior. Savings accounts are kept leaner, cash balances are moved more frequently, long-term commitments feel riskier. This is already happening. In the US, households keep less idle cash than they did a decade ago, not because they don't want security, but because cash feels less stable. In the UK and Canada, fixed-rate mortgages are no longer taken for granted. In Australia, households hesitate before upgrading homes, not out of fear, but out of arithmetic. The system adapts before it breaks. If silver's movement is indeed signaling a broader reset, then ignoring it means misunderstanding the nature of the change. This isn't about prices spiraling out of control. It's about the slow redefinition of value. What does money mean when it buys less predictably year to year? What does savings mean when growth barely keeps pace with living costs? What does stability mean when every institution relies on assumptions formed in a different economic era? One consequence is that debt becomes heavier without looking larger. Credit card balances don't need to explode to become dangerous. They just need to linger longer. When interest rates remain elevated, rolling balances stop being a temporary bridge and start becoming structural. A family in Arizona pays the minimum each month, not because they're irresponsible, but because groceries, insurance, and utilities absorbed what used to be discretionary income. Over time, servicing debt replaces building savings, even if incomes rise. Another consequence shows up in housing. Real estate doesn't collapse, it stagnates in real terms. Prices hold, but transaction volume drops. People stay put longer. First-time buyers delay entry. Renters stay renters. The system doesn't fail, but it becomes less mobile. That lack of movement has economic costs that don't appear on balance sheets. Job flexibility declines. Family decisions are postponed. Risk-taking decreases. This is where silver's role becomes clearer. It isn't forecasting chaos. It's reflecting constraint. Industrial demand continues because policy is committed to electrification and technological expansion. Monetary demand grows not from panic, but from hedging behavior. Institutions don't bet on collapse. They prepare for uncertainty. Long-term supply contracts, strategic inventory accumulation, and diversification away from purely financial assets all point to the same thing. Confidence is being spread thinner across more anchors. Smarter adaptation doesn't look dramatic either. Some households shorten financial timelines. Instead of planning 30 years out, they plan 5. Retirement contributions continue, but with more frequent rebalancing. Emergency funds are prioritized over aggressive growth. This isn't pessimism. It's realism shaped by experience. Some businesses rethink pricing and inventory. They hold more physical inputs and fewer promises. They lock costs earlier. They favor resilience over maximum efficiency. These decisions reduce headline growth, but increase survivability. At a policy level, governments lean toward management rather than reform. Structural fixes are slow and politically costly. Temporary measures are faster. Subsidies, incentives, targeted relief. These help, but they also reinforce the idea that stability must be actively maintained rather than assumed. Over time, this creates a new normal. In that normal, assets that straddle multiple roles become more important. Silver sits in manufacturing, energy, medicine, and monetary psychology at once. That's why its movements feel different from speculative assets. It responds to both factory orders and balance sheets, to solar installations and currency issuance. If nothing changes, silver doesn't need to skyrocket to matter. Even sustained repricing alters contracts, production decisions, and long-term planning. It changes how costs are modeled. It changes which projects move forward and which are delayed. It subtly reshapes industrial economics. For individuals, the lesson isn't to chase metals or predict exact outcomes. It's to recognize signals early enough to ask better questions. Questions about exposure, flexibility, and assumptions. Are income increases tied to inflation or lagging behind it? Is debt structured for resilience or for optimism? Are long-term plans built on stable purchasing power or on the hope that volatility averages out? These questions matter more than any single asset. A systemic reset doesn't announce itself with sirens. It reveals itself through friction. Things take longer, cost more, require more attention. The margin for error narrows. Silver's message, if there is one, isn't urgency for urgency's sake. It's a reminder that systems evolve whether people notice or not. The earlier that evolution is understood, the more choices remain available. History shows that periods like this are remembered not for collapse, but for transition. The shift from one financial logic to another, from assumption to adaptation. When people look back at the mid-2020s, they may not remember exact prices. They'll remember the feeling that the old rules were still written down but no longer fully applied. That's usually when a reset is already underway. And silver, quietly moving in the background, may be telling us less about where it's going and more about where the system already is.